Welcome, everyone. My name is Robert Ian of ConquerChange.com, and I'm joined tonight with Kerry Lutz of the Financial Survival Network and Craig Hemke of the TF Metals Report, a la Turd Ferguson here for the second Liberty Mastermind Webinar. Kerry and Craig, welcome.
All right,
Robert.
Hey, thanks for joining us here tonight. We've got a great format tonight. We're going to cover a lot of ground. I know things are going to go really quickly tonight. We've got all of our attendees that are kind of logging in and joining us right now. On your webinar, please feel free to type in questions here as we go. And we're going to be getting to the Q&A portion here in short order. And we're going to take as many questions as we can this evening. So just thought we'd start off quickly. Craig spoke at the Liberty Mastermind Symposium that Kerry and I had in Las Vegas in February of this year. He did a phenomenal presentation. And I wanted to start off tonight, Craig, and just ask you, you actually opened your speech with a book you held up by Ferdinand Lutz from Switzerland called Gold Wars. Yeah. And I had not seen anyone reference that book before, discuss it really openly. Could you maybe just lead into our webinar tonight and just maybe talk about why that book is so important and so special to you?
Well, it couldn't be more timely than right now, because Mr. Lutz was a Swiss banker, if you will, who passed away in 2001 and lived to see the much of the ending of the Swiss backing of the franc with gold. He probably wouldn't have made it to past 2011 anyway, because the events of backing it or pegging it to the franc would have given him a stroke and put him in the grave anyway. Mr. Lutz passed away, unfortunately, in 2001. I wish he was around today, because we could sure use him. You mentioned the book. It's funny, Robert. Here, it's right here. I didn't know we were going to talk about it tonight, but I have it with me because I thought there might be a thing or two that I would reference. I would encourage everybody listening. It's a wonderful book. It is it's full of all kinds of relevant information, even though it was written, like I said, 14, 15 years ago. It's fantastic. I didn't know anything about it. My background is just an independent trader. I've been trading commodities and options since I was in college back in the 1930s, and feels that way. And I kind of came upon the gold trade quite by accident. I never was really much interested in the metals much, really, before 2008, 2009. And you really, if the metals markets become a focus of your attention, it doesn't take long before you realize, something's not right here, and really, any market these days, you begin to realize something's not right here. But I began to just kind of put two and two together and figured out that these metals markets are manipulated and suppressed by the central banks and their agents, the bullion banks. Then when I read this book, it kind of brought it all together for me. I was referred to the book by a friend that I've made from across the pond, as they say, a British money manager by the name of Ned Naylor Leyland. And Ned came at it from the opposite direction. He read the book first in 2001 or 2, and a light went off, and then he really started getting into the gold market and the disparities and the non-economic parts of the manipulation. You can come at it from one way or the other, but the book really is indispensable. It's fabulous, and I would encourage everybody to read it, especially right now with the big Swiss vote coming up this coming Sunday. Again, Gold Wars by Ferdinand Lutz, which, I mean, could you have a better name? Ferdinand, I mean, that's a name you could give away, like if you were back in college at the bar or something like that, and you're meeting people, you say, I'm Ferdinand Lutz. It's a great name. But a far better book. I mean, it's just great, and I would encourage everybody to read it.
What do you see as like the main takeaway from the book? Do you have a high point in terms of his foreshadowing what we've been going through in terms of the actual wars between paper and metal? Any real takeaway that kind of resonates with you?
He wrote 15 years ago that the final nail in the coffin, the thing that would finally break the monetary system and say a goodbye to sound money was when they finally devalued the franc. That would be the last thing. And of course, Switzerland did that in 1999 and in 2001, and then they finally completely messed it up and eliminated everything in 2011. He was prescient in that. He said it was coming, and that's in fact what they did. Also, though, the book is, just from a history standpoint, to have in one volume all of the history of the suppression and the manipulation and why it's done, going all the way back to Bretton Woods in 1944 in the post-World War II days. You guys, I probably recall in the presentation that I gave back in February at the Liberty Mastermind Symposium, there's a lot of folks out there that are kind of circle around the gold trade. They know that paper money is not good, and they know that the U.S. continues to create it, as do all the other central banks around the world continue to just devalue their paper money. They know something's not right, and they don't really know enough about gold, but they hear we people that are called gold bugs talk about price suppression and manipulation, and they think, that's just some conspiracy theory, as if the central bank manipulation and suppression was something that was just, we're using it as a rationale or an excuse for why paper price has gone down for a couple of years. Nothing could be further from the truth, and anybody that tries to tell you that is either ignorant of the historical facts, or frankly, they just have some kind of a fiat money agenda. The suppression and manipulation of the gold price is historical fact, and a lot of those facts are detailed in Mr. Lipps's book. The U.S. began, after World War II, we had about 22,000 metric tons of gold. Again, as the winner of the war goes to spoils, I guess, and that's why the U.S. dollar was the backing of the Bretton Woods system. But there was already a run on that gold by the 1950s, as the U.S. was buying products from all over the world and shipping dollars, and then those dollars were being converted back into gold by the people that sold us those goods. And by the 1958, there was a huge series of investigations and committee meetings on Capitol Hill about where was all the gold going, because we'd already lost about 30% of it. And we'd gone from 22,000 tons to 16,000 tons, all the while trying to defend this $35 value that was arbitrarily set decades earlier. 1961, we decided we couldn't do it ourselves anymore, and so with 7 other countries, we came up with this thing called the London Gold Pool, where we pledged 120 metric tons or so, and these other countries pledged the same, and we tried to manage price and keep that $35 peg in place for about 7 years through physical sales. And eventually that fell apart because the physical got drained, and the London Gold Pool broke up in 1968, and that was all about suppressing price and keeping price at that $35 peg. And by 1968, we lost so many other tons of gold through international trade. We're already down to just barely north of 9,000 tons. And by the time Nixon closed the gold window in 71, we were down to our current level of 8,100 tons. And all of that metal was spent, if you will, trying to enforce and suppress the price of $35. The only reason that they've been, been able to manipulate the system as long as they have was that in 1975 they invented paper gold. And futures began trading on the COMEX in New York. That was where they finally got wise and said, well, wait a second. Why are we actually delivering physical metal when we could just invent metal out of the blue using leverage and paper derivatives? And that system has worked now if you want to call it that, for almost 40 years. But so anyway, this is a long, storied historical record of price suppression and manipulation. It's not conspiracy theory. And again, getting back to, I didn't mean to go off on this big tangent and soapbox, but a lot of that is from Ferdinand Lipps's book. And so I would strongly encourage everybody listening to pick up a copy.
Exactly. Yeah, no, it's really worth an amazing read. It's more timely now even than it was, especially with the history to look back over with all the manipulation and all the price movement that people can't make sense out of, and look at what he prognosticated, especially with the onset of GATA and other things that started in 1999, 2000 as well. And then you look at the written record since then. It's really pretty amazing. And Kerry, I want to kind of switch over to you and kind of just to have you do an introduction here for yourself. But before you do, I know you're going to discuss being a former lawyer, and you're giving me that look like Robert put the disclaimer up. I will in the when we put the video up.
Yep. Hold on one second. Jeez. Well, I've always had a thing for gold and silver from the time my brother came into the kitchen in 1965, and he dropped a bunch of the new, as David Morgan calls them, Johnson slugs on the floor, and then he dropped the 64 pre-65 silver quarters, 90% silver quarters. And I said, gee, those new ones really sound like garbage. They don't sound right. And somehow my fate was being cast. That one day I'd be a proponent of sound money, and literally the sound of the money. And what Craig says, the market's being rigged. Well, every market in the world is rigged now, except for the used car market. Who would think that the used car market would be the only market in the world that the government is not fixing the prices? I never thought I'd live to see the day. But yeah, we got a disclaimer, and Robert's got the disclaimer, so listen up and don't take anything. This is all for educational purposes, but I'll let Robert do the formal disclaimer. And right, we've got one of those.
Oh, no worries, and we'll post this on the video. But as Kerry always makes me put out, the webinar is for informational and educational purposes only. All the views that are expressed by Kerry, by myself, by our guests like Craig, are those of the individuals talking, not of the Liberty Mastermind LLC. The opinions expressed on this webinar and any others are not meant to represent investment, legal, or any kind of professional advice whatsoever. Viewers and listeners are urged to perform their own due diligence on all matters discussed on the webinar or debated here. No individuals or organizations on here will be liable to any one or any person for any decisions or actions taken in reliance on any information provided on this presentation. So please just sit back, enjoy, and we've got a lot of ground to cover here, a lot of good information to cover off here tonight. Let's start off. We got a lot of questions piling in here, and just a quick word on myself for those of you that follow GoldSeek. I close. I'm kind of like the little toy surprise at the end of every GoldSeek radio broadcast. If you go to the very end of the broadcast, for the last 7 years, I do all the little closing commentaries at the end of each GoldSeek radio show, starting in about mid-2007. So those commentaries go back and actually trace the run-up to the 08 collapse and the aftermath after and everything that's happened since. So it's pretty eye-opening when I go back and actually review them. It's like a little mini-series. Not something I like to relive too often, but it's good stuff. But I was just looking at your website and looking at your works again here, Craig. GATA distributes a lot of your stuff, and you had just written about the COMEX here just today or yesterday, I believe. And could you just talk a little bit about that? What do you think is going to be happening in the month of December? There's been a lot of speculation about where the price movement is going to go, about delivery. What's your best estimate at this point as to where the price is going to go?
Well, independent, and it has to be viewed independent of the COMEX, because the COMEX isn't a delivery market. They have to pretend, at least, that they're delivering metal, because without physical delivery at this electronically generated paper derivative price, without a physical delivery, then that paper price doesn't have any relevance. Okay, they have to be able to deliver metal at that price to have that exchange generated price having legitimacy. they will go through the motions and claim that there's 10,000 contracts standing for delivery, and they'll have delivery notices that'll be put out every night, and it'll look like deliveries actually happen. Now, if you try to follow that through all of the delivery reports and the gold stock reports that are put out by the CME showing movements into and out of the vaults, none of it will make any sense. And it's, frankly, because it's deliberately opaque. They don't want you to be able to see that really not much is going on behind the scenes. I mean, there might be some what they call warehouse receipts that are traded hands, but there's no real, no one's showing up and taking delivery of a couple of metric tons of gold and loading it into the back of a Brinks truck and driving it away. That doesn't happen. That does happen in London, but that doesn't really happen in New York. There's a lot of talk out there, and just do a Google search. Everybody listening, do a Google search. Type in COMEX default, and just see how many times this has been written about in the last couple of years. I don't want to say fallen for it, but I've written about it in the past. There's a lot of talk about it now because open interest, particularly in silver, has recently surged to all-time highs. And just in gold, actually, as well. Gold was down at a multi-year low in total contract open interest just 90 days ago, and it's gone up by over 30% since. And so everybody's, oh boy, yeah, December is going to be this big deal. Everybody's buying December contracts to take delivery and break the COMEX. If people are going to bed Friday night hoping that that's going to happen come Monday, they're setting themselves up for disappointment. Yeah, at some point, the scheme will unravel, and there won't be physical to deliver, and there will be some type of default. In fact, I was just mentioning this on my site, I don't know, about an hour ago before I came in to sit down with you guys. There is precedent for this called the Maine potato default from back in the 70s, where there was a delivery default. And the COMEX, or I think it was the COMEX at the time, or New York Futures Exchange perhaps, they just shut down all those contracts and just settled them at an arbitrary cash level. And it was big news for a day or two, and then it just moved on. Something like that will probably what happens eventually. To have everybody get their hopes up that it's going to happen in December, I think you're setting yourself up for disappointment. Now that said, there are all types of different data points and signals that tell me that wholesale supply of readily deliverable gold is extremely tight. And that is what has put a floor under the price over the last 30 days. Whether that will, maybe NATO will invade a country like Ukraine and take all their gold again to help break up the logjam. I don't know. But something is going to have to get fixed there. Either price go up so that some gold is shaken loose to physically deliver, or the markets are going to break. The physical markets are going to break. It's extremely tight right now, no doubt about it, and that's putting a floor under price. So that said, I expect price to rally in December. Hey, there's a big surprise. Everybody says old turds are permeable, and to a great extent I am. But I think the price has been driven down even probably farther than the banks would like to. The bullion banks would like to have seen it go a month ago because, again, they couldn't physically deliver metal at 1140. And so the fact that it's risen since then isn't really a surprise, and I think that is really the floor for this foreseeable future.
Yeah, so one thing is that on the COMEX, they've got the right to settle these contracts if they have to in shares of GLD. It's in the contracts. So there can never really be a default because if they don't have the metal, they just give you paper. And we've all heard the stories, and if you read Harvey Organ's column at all, of them settling contracts at a premium in cash in lieu of delivery, which is totally against all the COMEX rules, but they do it, we know. This is a way to make money.
I don't know. You know, I bless Harvey's heart. He's been at this a lot longer than I, and he may very well be right. But I think there's a lot of chatter on the internet about cash settlement and that kind of stuff. When I think a lot of folks don't understand that front delivery month, and what I'm talking about is right now the current front delivery month is December, the December gold, the December silver contract. And they have been the active trading month really since September. October's a delivery month, but it's real active. And so the December contract's been where all the action has been. That contract goes off the board and expires tomorrow, as a matter of fact. And it begins to move into its delivery phase. Well, while it's in that delivery phase during the calendar month of December, it still trades. Now, to own it, to continue to hold it, you have to have 100% margin, 100% of the cost of the contract, of 100 ounces of gold in your account. So that's why most people liquidate it and they move on to the next actively traded month. You're only going to hold it if maybe you're thinking about taking the delivery. So we'll find out by Friday that maybe 10,000, 11,000 contracts remain open. And so what a lot of commentators then do is they go, well, there were 10,000 contracts that were open at expiration, or what we call first notice day. But then by the end of the delivery month, there were only 7,000 deliveries made. That must mean that the COMEX cash settled 3,000 of them. No, that's not what happened. That contract kept trading. And so what very likely happened instead was that a holder of the contract that had put up the margin just said, I'm not gonna take delivery. I'm just gonna sell. And when they sold, the contract was closed and the open interest disappeared that way. So I don't know if maybe that is going on. Maybe Harvey's right. I'm not trying to say that he isn't. But there is an actual explanation as to why it appears that there's cash settlement going on. Again, we'll see that again in December. I'm certain of that. And that's, again, why I don't expect, this breakdown of the COMEX system, to be imminent.
Do you expect it at any time, maybe, or do you see it at some point, or?
Well, absolutely will at some point, because there's all, we were told by several people, and we've been told all year long about the vaults of London being empty, about Switzerland, all the major refineries in Switzerland running 24/7 trying to take gold that is coming out of London and re-refining the 400-ounce bars into 1 kilo bars of 4.9 purity, a new Asian standard, and all that gold is being shipped off to Hong Kong and then into Shanghai and gone for good. And so we know that there's a real scarcity of gold, but yet we know also about how many times that the Western gold has been leveraged and leased and released, and the industry term is rehypothecated. There is no clear title. There is no clear, to use an art term, there is no clear provenance to most of this gold. And so there are a lot of folks, there might be an ounce of gold sitting there, and there might be anywhere from 10 to 100 people that think they own it. And so that's the kind of the key to this whole system is, like I said earlier, for this paper price, which has been used to suppress and manage the global price of gold now for 40 years. For that paper price to have any legitimacy, there have to be physical deliveries made at that price. Because otherwise, the three of us could get together and say, I think gold is worth $100,000 an ounce. But if I'm not willing to give you my gold and you're willing to give me back $100,000 for it, we're just making it up. It doesn't have anything to do with anything. And so that's what the stress now is in the system, is that so much gold has been removed. Cruz Jansen thinks China's up now to 16,000 metric tons, basically what the U.S. was at in 1960. And he probably, I'm certain that he's right. So much gold has been moved from west to east that now that leverage, the amount of owners per available ounce is skyrocketing. And eventually that physical to paper connection that has to be there for the paper price to have legitimacy. That physical to paper connection is going to break. I think it began to break a few weeks ago when we got down to 1140. again, with these other stresses that I'm seeing in the global gold market. It will, there's no question in my mind, it will happen in the future, whether that's a month from now or in 2015 or 17 or whatever. What I just don't want to pin my hopes on is it's going to happen on December the 10th of 2014, and I fear that too many people are doing that. And then when it doesn't happen, they'll get disgruntled and, and storm off and that type of thing.
Yep, understood. Let me jump to our questions because we've got a bunch of them come in. I'll shoot through these kind of quick, and both you guys just kind of jump in. Let's kind of do just a back and forth free for all on these because there's a lot of really good ones that are going to kind of keep us all over the board here on various aspects of gold tonight. First one comes in from Jason. He says, "I've accumulated enough physical metal for now and am thinking about diversifying into mining stocks. Do you guys think that would be a wise move at this point?"
Kerry, you want to run with that?
Well, first, no personal, no personal financial advice, but who knows how long these low prices are going to go on? I just think back to Andy Hoffman, his feelings about mining stocks. It's at your own risk. It could turn out to be really brilliant, and you might cash in on the leverage. And on the other hand, these things could just blow up like derivatives. So you just don't know because the system is so rigged that the miners could be the unintended consequence of the whole thing when it blows up,
And they all trade on a stock exchange, an equity exchange someplace. And depending on the rules, they could just simply be shorted to nothing. Kind of like what we saw, if you remember back in 2008 when they had the naked selling of the banks and there was all this uproar as the bank stocks were going down to 5 and 4 and 3 and 2 and 1.
Yeah.
With this naked shorting and the hedge funds that have just unlimited leverage and capital to do it, they can drive these companies to zero, regardless of what their book value might be or how much cash they have. Theoretically, it could happen. And so I was late to the game, frankly, in swearing them off. Some folks like Andy Hoffman, who's a brilliant guy, he gave up long ago. I just was talking to a friend of mine named Jim Willey earlier today, and we did a podcast, and he was talking about how he thought he was late to the game, swearing them off in 2008. And they rallied like crazy from 2008 to 2011, 2012. There is potential there, and if you think that there are going to be some miners and mining companies that survive and prosper, if you think that this paper society, you think the paper exchanges and everything are just going to continue, and maybe not indefinitely, but at least for a while, like they have since 2008, then there's probably an opportunity to make some extra fiat currency that you can convert and add to your physical stack. But boy, that's going to take a lot of homework, a lot of due diligence. You got to listen to a lot of different sources, and you definitely have to diversify. The last thing anybody wants to do is say, this miner here, man, they've got a good ore grades, they got mines, they got labor under control and everything. So I'm going to sink everything into that one and just buy on a certain Wednesday. No, what you probably do is you identify a handful of them, whatever the right amount is for you personally, and then you just accumulate. You buy some here, you buy some there, and slowly build a position so that you're buying some on lower prices, you're buying some on higher prices, knowing that in the end, if you're right, whether you bought some at $6 or $6.50 or $5.40 isn't going to make much difference. If you're right, it ends up going to 25. So you accumulate over time, and you accumulate a basket, and that's probably about the only way that I would even consider.
Yeah, well, but if it's the time for the manipulators to get behind that sector of the market, and you're there, you're going to clean clock. That's the other thing you have to consider. Like it was in 11. Like in 11, a clean clock on it, and I can't say that I was doing anything that brilliant, but it's the first time in my life I ever got stocks went up 10, 12 times, and You know, it was just their turn. And if you look at the market, you see that everything else is way, way overpriced, but this sector is just sitting there, sitting duck for these guys, and they turn their charms to it. It could be the time, but, you know, like, who knows? You know, the whole thing is rigged.
And to your point, Kerry, there's the index. You know, there are several mining indices, like the the S&P 500 is an index, or the Russell 2000 is an index. There are several mining company indices. The one I follow that has a pretty long record, or a track record that you can go back and look at, is called the HUI. It's the Amex Gold Bugs Index. HUI is the symbol, and I can get about 16, 17 years worth of history on it. It has come down so hard and so far, just even recently, that as of earlier this month, it was at levels not seen since 2008, and before that, 2004, and before that, 1998. And so, from a historical perspective, now would seem to be a pretty good time to be adding a few shares, if you're so inclined to do that. But again, like we've mentioned, you understand what you're undertaking, and diversification is your key, and you gotta just kind of average a little bit over time and accumulate and see if you're right.
And you have to be really careful on your timing, because go back to 2008. I can speak from personal experience. You know, a month before the collapse in 08, you know, mining stocks looked really good, but you know, I put a small chunk of money into mining stocks like 3 weeks before the collapse, and then they lost like 90% of their value. Now, if you'd have waited 6 weeks when those same stocks had lost 90% of their value, and then put in that same amount of money, and then, like you mentioned, Kerry, by 2010 or 11, when they had actually rebounded from those lows, the mathematical difference in what you would make is, I mean, you can just run the numbers. I mean, it's just vastly significant. So it really depends when and how you buy. But generally speaking, it's a sector that's been absolutely beat up, starved for capital. At a lot of the major gold conferences, this was big news, everyone knows, the last year or so, but there were estimates like 600 or 700 or 800 of the junior mining stocks on the TSX Venture Exchange had, you know, $200,000, $300,000 left in their bank accounts or less, and no prospects for capital. I mean, it costs that much just to keep a public company active every year, or thereabouts. So these companies are starved for capital, and you know, when their share prices drop, I mean, how do they actually raise capital and move the company forward? I mean, the whole market is starved right now, the mining sector. It's like, my observation has been, what happened in 3 or 6 weeks in 2008, it has happened now over like 3.5 years since 2011 to the mining sector. It's been a real downturn, but it's taken 3.5 years. And if people, there's a lot of people out there that are thinking that the stock market could actually drop significantly from the level that it's at. Well, I mean, mining stocks are no winners right now, many of them, especially a lot of the juniors. But I mean, imagine a big downdraft from the point that we're at now. I mean, it would be horrendous. Now, true, they might actually go up in a downdraft on the normal stock market. I mean, who's to say? This is worse than a rigged craps game or blackjack game. I mean, there's just no way to know. But it's you know, that disclaimer we talked about at the beginning of the show, for what we're gonna. You really need a disclaimer if you're gonna be involved in that sector of the market. I think that's my view. But just jumping in here, next question here pertains to the Swiss gold vote. It says the Swiss. It says, if the Swiss vote is a yes on Sunday, how soon must the central bank repurchase gold to the 20% level?
Robert, I have to stop you for a second. For the majority of your question, I lost audio. So would you mind asking that again?
Yeah, no worries. Yeah. It says, if the Swiss vote on Sunday is a yes, how soon must the central bank repurchase gold to the 20% level?
You know what? I can't remember. I could take a second and look it up. I've studied that initiative and I've written about it several times. That specific clause, I can't remember. Maybe we can pull that up before the end of the night, see how quickly they have to act. But I know it's definitely right away. It's going to hamper the Swiss National Bank's ability to continue to devalue the franc. That's no doubt about it.
And print money. Yeah. Yeah, there's a time frame in there, if I remember correctly, and if I were a betting man, or if I were still a betting man, I'm betting that it's going to pass. We talked about it before, the three of us. My belief is it's going to pass if there's an honest vote, which is always an if. So, just my own personal opinion.
Yeah. It's an actual, I don't know if there's an electronic ballot too, but I've actually seen the paper ballot. Somebody, I saw it on Twitter, and so I was able to pull it off there, and I posted it on my site, and somebody right away, you know, because Switzerland has, what, 4 national languages, I think, right? French, German, Italian,
Yeah.
whatever the other, I can't say the other one.
Italian.
So, the ballot is printed in all 4 languages. And the actual language on the ballot is, shall we save our Swiss gold? Or do you want to save our Swiss gold? And I mean, it really says that in all those languages. I was really surprised because you wouldn't want to do that. I mean, if you're just some regular guy in Switzerland, you know, who's been walking around your lederhosen and collecting Edelweiss on the Matterhorn, and you come down and it's time to vote, and your ballot says, shall we save our gold? Yeah, I want to save gold. So in that sense, my initial thought was, yeah, we got a real shot at this. But as you said, Kerry, like we saw in Scotland, yeah, maybe the pensioners in Scotland, the old folks, wanted to stay a part of the United Kingdom for their own, you know, whatever selfish reasons, and so that was a legitimate vote. Probably was, but it definitely was incentive to make sure the Scottish referendum for independence didn't pass. When the City of London comes out against it, you pretty much know, you know, which side you're on. Well, there's clearly the propaganda in Switzerland and around the EU against this initiative, making the Swiss out to be, you know, weird and backward because they don't want to just play ball with fiat currency like everybody else. I mean, the propaganda's thick, and obviously the bankers and the central bankers who have the power are staunchly against this. And so I wouldn't hold anything against them. You know, whether the votes can be rigged, and maybe not. I don't know. I'm not as optimistic as you are, Kerry. But gosh, it sure would be fun to wake up Monday and hear that it was a yeah.
Well, the reason why I'm so optimistic is because PayPal cut off contributions to the pro-initiative side. All right? So PayPal didn't just come up with this idea and say, you know, we don't want the money from the millions of dollars. We don't want our 3% of it. They were obviously pressured by somebody, the powers that be, to cut that money off. So the powers that be, those few $1 million that would go into pro-initiative advertising, felt that this thing's a real threat.
Yeah.
So if they're pressuring PayPal to cut off the contributions, somebody's pretty scared about this thing, you know?
Absolutely. And so we'll see. We'll see. I've got my fingers crossed, that's for sure.
What do you think about the margin of error? They're talking about like 17% undecided, but I've heard numbers like 6%, 7% margin of error. I mean, let's face it, our political campaigns and polling mechanisms are down pretty good. They can actually calculate this stuff pretty accurately. It seems like such a big swing. It seems almost like a battle for everybody's mind in terms of propaganda to kind of either to keep them at home, basically, to say, there's no point to go and vote on this. I guess it's already done for, so I'll just stay home and do something else. Did you guys see that as more of a perception or a perception war than to kind of keep people at home rather than, I mean, because it seems like just such a big swing.
Yeah, I'm sure that's the case too, Robert. No doubt about it. And again, like you guys have said, I mean, it could go either way, and it really is up in the air. If it does pass, there probably won't be some big explosion in gold come Monday. If it doesn't, I'm sure it'll be used as an excuse to sell gold off by a couple of percent. The impact, but I guess what I'm saying is I don't anticipate a real significant impact either way. But if it does pass, it is a real game changer. You're already seeing, we know about Germany and their repatriation request that was halted last year, it appears, at 5 metric tons. And then the Dutch jumped the queue, and it was just announced last week that they had kind of secretly repatriated 120 tons out of New York, and now the French are saying they want to get in line. It could really snowball, no doubt about it, if all of a sudden the Swiss are not only demanding the return of their gold held abroad, but also now they have to begin backing the franc with gold as well. It would be a significant change, a game changer, if you will. So, like I said, we're going to do one of these things all weekend long and see how it goes.
I think it's the beginning of the end for fiat currency if it passes. I don't think the Swiss will implement it. I think they'll find reasons not to. State of emergency, something will happen that they don't do it, but the people will have spoken in a country that isn't that significant in terms of its size, but in terms of its quirkiness, of its individuality, in terms of its history, it's significant. It will make a big difference. I don't believe they'll implement it. They'll find reasons because it's a country of banks. If you've ever been to Switzerland, you go to Geneva, you go to Basel, it's a bank on every corner, and the banks run the place. But the people will have spoken, and it's going to set something off in the world that the governments and the banksters are not ready for. That's my personal feeling on it, but we'll see come Monday.
Yep.
Kerry, you interview a lot of people. Has anyone, and Craig, you as well, have you heard of anyone discuss if this doesn't pass? Have there been any rumblings within Switzerland about them bringing this up again in another year? Because
it's such a process there to get this on the ballot in the first place.
Mm-hmm.
This took several years to get to this point.
Okay, it took several years.
My first guess would be it wouldn't be unlike I guess the closest American equivalent is maybe the proposition language, the direct referendum that they have in California. You can bring up something, make a new state law essentially in California by getting enough signatures and putting it on the ballot. That's kind of similar to what this is.
Okay.
A lot of times those ballot initiatives, once they lose, you don't see them again.
Right.
Because, you only have the momentum one time. And so this may be something similar to that. I mean, what the path the world's going down, yeah, maybe they'll take another stab, they'll get wise in a couple of years and take another stab at it. But I don't think it'd be something they turn around and have the machinery or the will or the dollars or anything to take another stab at in the short term.
Hey, look, they had a $25 minimum wage thing that just got beaten this year. This is the medical marijuana of Switzerland. This is like the marijuana initiative of Switzerland, but a lot bigger than that. This is where the people get to put it to the bankers. I don't believe they're going to miss their opportunity. I just don't.
I hope you're right, Kerry.
Yeah. Hey, I could be wrong. I've been wrong lots of times. I don't pretend to have a crystal ball, but I just think it's too good an opportunity to stick it to everybody. I don't think the people are going to pass it up. But hey, we'll know Monday, right?
Yep. David asks us, he says, are we headed for a global depression in the next 12 to 18 months?
Some would say we're already there.
Yeah. What have we been going through here?
If you're measuring a depression based upon, all these Keynesian statistics like gross domestic product and things like that, maybe. I don't know. All of the problems have just simply been papered over from 2008. I mean, we've been working with insolvent banks since 2008. And all of their problems have been papered over through government handout and corporate welfare, that we call quantitative easing. And then also by a simple accounting trick, which allowed these banks to value these worthless securities on their books as if they do have value. Instead of marketing them to their actual market value every day, they get to mark them as having the value that they'll have at alleged maturity in 30 years. And so all these accounting tricks have, and quantitative easing have made it look as though we have a healthy banking sector, a healthy global banking sector, when in fact we don't. And so with all of the derivatives, are keyed off of interest rates and currency swaps. I mean, we're just a couple of bad trades and a couple of bad ticks away from another domino effect. So to answer, was it David? To answer David's question, I don't know. Yeah, yes, no, maybe. All I know is I think we've all been surprised that they've been able to hold the system together through all these tricks as long as they have. I mean, if you go back to 2009, we all thought, well, certainly, God, 2010 is going to be a disaster. And now here we are in 2014. We'll see. Again, though, the key, though, is the system is not sustainable longer, and it eventually will fall in on itself. That is just a mathematical certainty. To be able to say that it's within the next 12 months or 18 months, that's a tough one. I think all you can do is just know that it's a certainty that it's coming, and then just prepare for that certainty.
Yeah, and I would just add to what Craig has to say, labor force participation rate, what would happen if the EBT card stopped working tomorrow?
Yeah.
I mean, we don't have bread lines like they had in the Depression. We have virtual bread lines called EBT cards. What happened in those Walmarts where the EBT cards stopped? They couldn't tell what the limits were, so they let them just say no limits on your EBT cards, and they had riots there. This is not an indication of economic health, and this is all over the world. And there is, I think, Howard Katz used to have passed away a couple of years ago. He had a newsletter called The One-Armed Economist, and he said a depression is simply when everyone in the world gets poorer, or the majority of the people in the world get poorer. By that standard, we're in a depression. So, we don't need to look at GDP or anything else.
Yeah, even in the U.S., what the median income level has fallen by almost 15% in the last 5.5 years. And at the same time, the cost of living, at least if you measure it by just the staples we all need, meat, milk, gasoline, that type of thing, all of that has gone up by at least 50%. And so, yeah, your point, Kerry, is that a depression? If you have a $500,000 401k and a $200,000 a year job, you probably don't think it is. But if you're everybody else, mom and a husband and wife trying to make that 52.5 median income and pay your mortgage and pay your taxes and put away a little money for your kids' college or their marriage or take care of your parents, all that kind of stuff. Yeah, it's a depression right now, regardless of what Paul Krugman and some fuzzy-headed economist might tell you.
That's right. My health insurance went up 54%. I just got my notice from last year.
Oh, that's not. Huh. You don't look too good either, Robert. You feel okay?
Yeah, well, no. Hey, it's just the way it works. There's no inflation, though.
What are you talking about?
There's no inflation.
You just got that bill. You're not feeling too good, yeah.
So, which leads us to the next question. Is the U.S. military strong enough to continue to enforce the dollar as global money?
Yeah. I almost went there a second ago. So can I run with that for a second?
You go for it, yeah. Your show.
Well, the U.S., as we were talking about earlier, has been printing money with impunity ever since 1971. And the reason we've been able to do that and avoid hyperinflation is there has been a demand for those dollars. We ship them globally, whether it's by buying products, cheap garbage from China, or whether it's crude oil from Saudi Arabia, whatever, those dollars go globally. And then they get plowed back and kind of sequestered, if you will, in our treasury bond market. And that because the dollar is the reserve currency, that system has kind of gone around and around and around and reinforcing itself. But what is now happening is people are figuring out, one, not only these economic problems that are papered over and are certainly that our system is broken, that the only solution that all these central banks have is just to print more and more money and go deeper and deeper into debt. And eventually these creditor nations, the dollar creditor nations, whether they're the BRIC nations of Brazil and Russia and India and China and South Africa, or whether it's the next level down, Mexico and Indonesia and Iran and all these, they're not going to play this game forever. And they're going to begin to, and they already are, either stop buying treasuries, or they're going to begin to liquidate those treasuries while they can, take those dollars and buy other assets. Well, anyway, that breaks all of these trillions of dollars that we've printed since 1971. It breaks them out of that sequester, if you will. And all of a sudden, they just start sloshing around, and they start coming home, where they've been tied up in this rolling over schedule of treasury maturities. All of a sudden, that overwhelms that, and all these dollars come home to our shores. And if you're listening and you took Econ 101 back in college, you remember that if the supply of something increases and the demand for it, even if it just stays the same, the value of it goes down. And that's what we're talking about with the dollar, and that is what is ultimately going to drive, I don't know if it's a hyperinflation, with wheelbarrows full of money like Weimar Germany, but at least a really significant and substantial regular inflation. Not this Bureau of Labor Statistics kind of nonsense of 2%, but the real inflation, 20, 30%, 40% stuff. That is what is coming as the rest of the world finally, and they will, move away from the dollar standard. I think it's almost human nature, in a sense, to think that tomorrow is going to be just like yesterday, because it's really your only frame of reference. For the three of us and for everybody listening, all we've ever known is U.S. military and economic superpower. The dollar reserve currency, the anchor of the Bretton Woods system after World War II. I was born in 1966. So what do I know about what it was like in 1926 or 1876? Nothing. All I know is my own frame of reference. And so it's really, really hard, just from a, again, human nature standpoint, to even begin to imagine what the world would be like if the dollar was no longer the sole reserve currency. So it's really difficult for people to get their minds and arms around what's coming, because the dollar has been the reserve currency for 70 years. And prior to that, it was the pound sterling. I mean, there's this march through reserve currencies that is in the historical record. Where we're going from here, it could be a Chinese currency could emerge as a regional currency. There could be baskets of regional trading currencies. We're already seeing direct swap lines being set up between Russia and China and Iran. All these types of things to where the dollar's cut out of the picture. We're heading in that direction. What it means to you, my listener, is that you are going to experience in your lifetime, in relatively soon, this really strong, and if you're old enough to remember the 70s, what that was like, that's what's coming back, if not worse, and that's what you have to prepare for, because again, it's a mathematical certainty that this is coming, but it's very hard for people to understand that because it's so different from what you've experienced thus far in your life.
Yeah, I think we would have been here a lot sooner. Maybe 3-4 years ago, was it not for the oil boom, the energy boom, the fracking boom in the U.S., which really kept the whole thing afloat, helped keep it afloat for the past few years. million jobs, we would have been sans a million jobs in the U.S. economy without it. And again, that was a function of fiat dollars being printed into existence, cheap money, all the good things, the good life being printed into existence. Now we see this implosion of oil prices, in large measure because this depression is taking place. And, you know, people I talk to, the cycle guys, think that oil prices are going to go up a little later in 2015. Is it going to be too late? I don't know. But, hey, I totally agree with Craig. You know, dollar hegemony is going to be a thing of the past in the future here, in all likelihood. But, you know, also, the other thing that's keeping it up is that you can't trust any of the banks in the world. We wouldn't go to sleep putting your money in a bank in Europe, a bank in Russia, a bank in China for that matter. You know, there is no stability in the world financial system, and that includes the U.S. But people, if you've got a couple of $1 billion you're running, you'd probably rather put it in the morgue than to put it in a bank any other place right now. But that is not going to be, that's not going to be a lot of assurance in the future. But for right now, it's okay.
And that was that whole bail-in idea was institutionalized just last weekend at the G20 meeting in Brisbane, Australia. So now all of the major countries will adopt into their banking rules this idea we loosely call a bail-in, meaning that if you have money in a bank, even above a minimal level, and your bank is insolvent, goes bankrupt, part of the resolvency plan will use your money to make it happen. So this idea, you know, again, we've all grown up with FDIC, and if, you know, as long as you have $100,000 or less, you know, the government will, you know, make you whole and all that kind of stuff. And that even happened, you know, worked all the way through 2010 and 11, where we were having 4 or 5 bank seizures a weekend. But yeah, that's the new way of the world. To get back, I guess, if I recall, the original question was, can the U.S. military enforce this? Well, yeah, that's what it ultimately comes down to, because I really doubt that the leaders of the U.S., by extension the bankers of the U.S., will go quietly into the night, right? Those that have the power don't just like say, okay, well, we'll just give up and we'll let you now have it. Doesn't usually work that way. There's usually bloodshed and war and all kinds of strife that leads up to that kind of global currency, global monetary change. And so with our military might, you got to figure, yeah, there's more war to come. Let's hope there isn't, but there probably is, as the U.S. tries to use their military might to shore up their you know, fading economic might.
And, you know, despite whatever geopolitical packaging is put on any kind of conflict, there's always a financial component to every war.
Yeah, and I mean, if a courageous, actual forward-thinking American leader would be working with the Chinese, would be working with the Russians. And believe me, I'm no fan of the Chinese. I mean, when I graduated college was right when Tiananmen Square was happening. So I'm not like sitting there going, oh yeah, boy, I sure wish I lived in Beijing. But in the economic reality that we face, we should be looking at our creditor nations and trying to come up with a solution, rather than painting them as enemies that we have to fight, like, you know, Russia and moving troops to their border and all that. I mean, we should be working with them to kind of come with some amenable solutions so that we can, I guess, share power going forward. Yeah, that's not the way we are. There's an arrogance involved based upon that military might that I'm afraid is going to probably lead to some kind of disaster. You know, hope for the best instead.
Prepare for the worst.
Yeah.
This next question is premised on a a service that you actually provide called Turd's Vault. And could you, from your private podcast collection, for anyone that's joining our webinar today, could you just take a moment and just, before I give this question and its origin, could you just kind of just tell us about that real quick?
I'll be happy to. It's funny. It still strikes me as funny when I hear that. Even my mother calls me Turd, for crying out loud. What's really fun is, since I've gotten into this 4 or 5 years ago, through the magic of the internet, I know you guys. I've met people all over the world. A really wonderful gentleman that I've gotten to know is Alistair McLeod, who works for Gold Money, and he's a Scot. And so what's great is when Alistair talks to me and I get him on Skype or something, and he says, "Oh, hello, Turd. Wonderful to hear from you." And it sounds so regal, even the word turd in that accent. It just sounds fabulous. But yeah, so that name, first of all, and the reason I even have this notoriety, this website, this, everything that comes with it, was I was involved in and signed up at, in a very early stage, a site called Zero Hedge, which probably a lot of people who are there listening know of. And back in the day, it was really a neat place. I mean, it was populated by a lot of Wall Street, which I wasn't, but Wall Street prop desk traders, and they hung out there. It was like their own little forum where they would complain and about the system and all the crimes and everything else that they saw. And it was really neat to be a part of it. And it's grown now, and it's still a wonderful site, don't get me wrong, but it's not what it was 4 or 5 years ago. But like any other site like mine, when you sign up for, when they cite you, you're anonymous, you got to pick a name. And I had seen, as I'm signing up for Zero Hedge, I'm thinking, what am I going to call myself? And had I known, crying out loud, I'd have picked something glamorous like Robert Ian or Kerry Lutz.
Two faces for radio over here.
I'm scratching my head going, oh, what names? I'm filling out the little online thing, and I think, what should I call myself? And I had just seen, somebody had sent me a link to an old Saturday Night Live gig of Celebrity Jeopardy, where during the course of the game, the Burt Reynolds character changes his name to Turd Ferguson. I thought, that's kind of funny. Yeah, okay, I'll call myself Turd Ferguson. Okay, now I'm stuck with it. Turd's Vault. We tried to run a free website for a couple of years, and it worked okay. But as interest in the metals waned, advertising revenue fell off. Google ads, all that stuff fell off, and websites aren't free. That's for sure. I mean, it seems like they're free because you get on the internet and everything's free, right? No, to run an actual website, it costs a lot of money. And so I instituted a small little subscription component of $10 a month. And that's where I keep my analysis, my daily podcasts, and it's called Turd's Vault. So anyway, I'm sorry to give you that.
No, it's good. It's a good story. That's what this question originates from that vault. It says, Silver broke out its channel, as you note in your podcast. What fundamentally could drag it back, other than manipulation? Is there a fundamental reason for silver to be lower? Miners, physical demand, fundamentals, COMEX, what?
I don't think so. Now, again, look, remember who you're talking to here. I'm the guy that was completely caught flat-footed in 2011, 2012, I guess would probably be better. When QE to infinity, QE3 was announced, I mean, it was damn the torpedoes full speed ahead. We'd seen this before. QE1 happened and gold went up 70%. QE2 happened and went up 60%. You're thinking, here we go. Well, what we didn't anticipate was the extent to which the Fed had seen this too and said, well, we can't have this, because again, that's all part of why gold is managed and suppressed in the first place, is because it's a measure of a lack of confidence in the central planners and their fiat currency. And if gold's going through the roof, it's a vote of no confidence in what they're doing. And so you can pull up all kinds of charts. Go back to October of 2012 when QE started. The money supply took off, the Fed's balance sheet took off, the stock market took off, and gold went straight in the toilet. And so it's definitely possible, and it just as it has been for the last 2 years, for the paper price to be driven down regardless of the fundamentals. Again, because it's all done on the COMEX. And there's just swapping paper derivatives. There's 5 or 6 active bank trading desks on one side of the trade and about 50 or 60 big hedge funds on the other side. There are no miners. There's no global supply that's taken. No, it's all a function of momentum and how the chart looks and all this kind of jazz. And so anyway, to answer the question, yeah, sure, silver could go back down, no doubt about it. And it broke out of this channel that it had been in for the last, since July. It just broke out of it today, which is potentially quite significant and makes it look like some type of bottom really was reached a few weeks ago. I think more importantly, though, it gets back to what we talked about earlier. The only reason that paper price, which has been so uneconomically driven down for the last 2 years, the only reason it has had significance is because the bullion banks, the banks that are responsible for delivering physical metal at that paper price, they were able to find the metal. They drained the vaults of London. They shook 500, 600 metric tons out of the GLD. They've reached and released gold out of all these unallocated accounts all through Europe. All these different things, right? When we got, though, down to, on November the 5th and 6th, 3 weeks ago, we got down to, whatever we got to, 1535, 1135 in gold, 1520 or so, 1501, whatever it was in silver. I think that was the point when that paper physical connection finally broke, and they weren't able to source metal at that price. Gold has rallied since. Whatever it's rallied, $70, 6-7%. Silver's rallied $1.50, almost 10% in 3 weeks. Hey, do you know that? That sounds pretty good, doesn't it? And it's because they got to that point where they were having trouble sourcing the metal. We see it in what's called the London gold forward rates. They're substantially negative all the way out to there are 1 month rates, 2 month rates, 3 month rates, 6 month rates. All of them are now negative, which means it's more valuable to actually have gold than dollars. It means it's very hard to find gold for delivery and for lease. Anyway, the fundamentals are what broke us out of that channel. So to make a long answer even longer, yes, these banks and the momentum trading that they drive and elicit from these hedge funds, yeah, sure, they might be able to drive it back down and try to reinitiate the downtrend. But I really think at $15 silver and at 1130 or 40 gold, that was the breaking point. And I firmly believe that we found a physical floor to the paper price 3 weeks ago.
Agreed.
Next question. Did you know that one of the major refiners is very low on silver, so low that one of the mints has to wait a lot longer to get product? And do you think this will still be that way in a couple of months?
Yeah, you hear anecdotal stories like that all the time. The Sunshine Mint is one of the big mints. They produce the blanks. There are all kinds of anecdotal stories about that wholesale silver. There's a great analyst that's on my site a lot. He's got his own site by the name of Steve St. Angelo, who monitors all that really, really closely. Ted Butler talks about it all the time, about the amount of above ground wholesale silver. People will say, the people that think it's justified that silver is at $16 and that they think it's going to 8 and 5 and all these ridiculous numbers, and they'll say, all these precious metal people say that there's a shortage of supply. Well, I can go online to GM Bullion or Provident or any of these places. I can get a Tube Eagles anytime I want. I can go down to my local coin store and pick up a 10-ounce bar of silver anytime. That's not what we're talking about, man. We're talking about the 1,000-ounce wholesale bars. That is what appears, that the world appears to be kind of living hand to mouth. It's that 400-ounce standard London bar that appears to be in short supply too. And that these banks are delivering and meeting demand with, not with built-up stocks of supply, but with flow of supply. Taking it from point A and delivering it to point B just to kind of keep everything moving. The situation really is that tight. So we get these anecdotal stories like the questioner, like that question said, and I think they're all true. I think, or at least on balance, they're all true, and I think that it's indicative of a real supply squeeze. And they mentioned one of the questions mentioned earlier, the fundamentals of miners. It costs money to get metal out of the ground, and to keep your mine up, and to keep your labor force in place, and all that kind of stuff. There's an all-in cost that many people cite of $18 an ounce for a lot of silver miners. There's a sustaining cost, of actually keeping your company going. A lot of folks close to 21 or 22. Now, a lot of silver mining is done by other base miners, and only maybe 25% of global supply comes from companies that only mine silver. So it's the byproduct of zinc and lead and other kind of mining. But nonetheless, there becomes a point at which it is not economically logical to continue to mine. And getting back to Econ 101, if demand stays the same and supply falls off, price goes up. I mean, it is what it is. And I think, again, we found that spot a few weeks ago at about $15 silver. I feel really...
We know it because First Majestic just said we're not selling our silver anymore. A big portion of their production they're holding back. And if they're doing it, pure silver play, probably Fortuna and others are going to do the same thing. I mean, there's a limit to really well-run silver miners. How many of them can afford to just produce at an operating loss, right?
Right. It's like if on the Chicago Board of Trade, if all of a sudden the paper corn traders drove the bushel of corn down to 50 cents a bushel. I mean, it's already down to 3 something, but if they drove it down to 50 cents a bushel, who the hell's in their right mind's going to grow corn? I mean, it costs so much money to get the seed and to put it in the ground and to fertilize it and ammonia and all that other stuff. And if it costs you $2 a barrel or a bushel to grow it, you're not gonna do it when you're only going to get 50 cents back. It's the exact same thing. That's why there has to be this connection. And the commodity markets, the futures markets, they're different from the stock market. People think, well, yeah, it's just this paper thing, and the companies issue more shares, and it just trades. It's an entirely different thing. You have to have a connection to the physical underlying commodity. Otherwise, the whole thing is illegitimate. And again, I'm coming back to the same point. I think we reached that point 2 weeks ago. I really do. And it sets us up for not only a strong December into the end of the year. I may be dead crazy, and we'll be looking at $900 gold by a year from now. But I sure think that next year is a totally different year as the world comes to terms with this real shortage of actual metal.
And it's funny that you mentioned corn, because prices went up last year, led to major planting. Prices are down now, and it's going to lead to a smaller planting. And hey, we didn't even talk about the booming demand for silver. I mean, all of the major uses, solar, medical. I mean, the uses and electronics, every iPhone, trace amounts granted, but the demand for silver just keeps going up and up and up. So the price action alone on those demands, and we're not even talking about investment demand from India using silver as a substitute for gold, and China. And, to me it's inexplicable. There is no explanation for $16, $17 silver. No market explanation. There just isn't.
The only explanation is, again, the media, whether it's NBC or Bloomberg or some analyst you read on Yahoo, will have you think that that the paper price is somehow determined by a whole world full of people transacting, exchanging silver for dollars. And that's not even remotely the case. The silver market in New York is tiny. And if you look at for what it's worth, if you look at the CFTC generated data, there's maybe 3 or 4 banks on one side of the trade, and there's about anywhere between 35 and 40 big hedge funds. That's it. You got 3 or 4 banks taking one side of the trade and 30 or 40 hedge funds on the other. Yeah, there's a bunch of small traders like you and I, that might have 5 contracts or something. You're not going to do anything.
Not me.
Big hedge fund. And you're like, yeah, you're smart enough, Kerry, not to be doing that stuff. But it's not, again, so the perception that it's some big market. Well, investors today sold silver, and that's why it's down 20. No. A handful of hedge funds saw the momentum and piled into the short side and drove the paper price of silver down another 20 cents. It has nothing to do with economic reality. And in the end, what's really tragic, and Robert, you touched upon this earlier, is the miners, the mining companies which employ real people who have real families, not just in the U.S. where maybe they can go get a different job someplace, but in Peru and in Mexico and in all these underdeveloped third world nations. They are working in substandard conditions, making a far less than a livable wage, risking their life every day, and not getting paid for it because some greedy banker and some greedy hedge fund are fighting it out every day, trading derivatives in New York. It's barbaric what they're doing to these people. It's maddening. It makes me sick, and I cannot wait for the day when it all comes to an end. Now I'm really on my soapbox. I apologize, but it's a little paper market. These hedge funds and the banks move it around all over the place to wherever they want it to be. It's not connected to economic reality, and there are real people in the end, not just investors like me that might have lost some money and some options. I'm talking about real people with real families that have suffered because of it, and it makes me sick, and I cannot wait for it to end.
The damage that it's done to these companies. Forget about some scammers up in Vancouver, scamming the public on shares. But the real companies actually producing real metal from the ground. It is sickening.
Yeah, no doubt about it.
With silver, someone asks here if now might be the time to trade in some of their physical gold and buy physical silver, with the pricing being where it's at right now.
The ratio would suggest that. A lot of people look at the gold-silver ratio. When you take an ounce of gold divided into or silver divided into gold, and you get 72 to 1 or whatever it is. It's way out of whack compared historically. And so it would suggest that. And there's a lot of people that, over their kind of a long-term investment standpoint, that's what they do. They start out maybe 50-50, and then they watch that gold-silver ratio and decide, okay, now now's a good time to take some gold and buy some silver. Now's a good time to take some of my silver and go back to gold. There's nothing wrong with that. That ratio would suggest, because it is so heavily skewed now in favor of gold, that silver's it's more of a bargain. You want to look at it that way? More uneconomically priced, even though they're both grossly underpriced. Silver, in relation to gold, is even more so.
The one thing I noticed about that ratio, and it's only useful as a relative measure between the two, because, like Craig says, they're both so grossly underpriced now. My opinion is that ratio touches, it's gone up to 80 to 1 a number of times in the past. When was the last time? And was it in 11? Was it, or 10?
9, 8.
9 or 8, but it doesn't stay there. The one thing just like platinum to gold ratio, okay? Post World War II, platinum, hits the gold price equal to the gold, or even goes below it, like a couple of years ago, and it'll stay there for 6 months, even as long as sometimes a year. And then it's going to go back. It almost has to. And when you see a ratio like where it's at now, and it was up to 75 to 1 a couple weeks ago, now it's about 72.5 to 1, you just know. You don't know what's going to happen, I don't know what's going to happen. Can't even tell you what's going to happen. I won't even try to guess. I just know it might go up to 80, but it is not going to stay there. Something will happen. Mark my words. Tonight, saying it November 25th, it's not going to be at 72.5 to 1 next year.
Well, tie in the next question then. How do you see metals valued if the fiat currency collapses?
It's kind of irrelevant. It doesn't matter.
Because it really is impossible to say, because the only way some people have tried to come up with a valuation is they look at how much fiat money there is laying around versus how much gold there is, and you divide one into the other, and you come up with, if you use the M1 money supply, you get $9,000 an ounce versus, our 8,000 metric tons of gold that we allegedly have. If you use M2, you get something like $11,000 an ounce. And you've got to have a numerator and a denominator. The problem is we don't know what the denominator is, because we don't know how much gold there really is. Because it's all been pledged and repledged, and like I said earlier, there's no clear provenance for any of this stuff. And so we can't say, I think gold should be $12,000 an ounce. Because you don't know how much there really is. And so it's impossible to say. All I know is it ain't worth 11.90 or whatever the hell it is. When it's all shakes out, it's going to be worth a lot more than that. And again, now, what do you do with it? I get asked that a lot, Robert. I get, well, what are you going to do with your gold? I mean, because again, if you're going to punt now, if you've ridden this whole ride down for the last couple of years, and now you're going to take your gold and sell it for $1,200. Yeah, you're selling it for $1,200, right? You're going to get 1,200 Federal Reserve notes back. I don't want those, right? That's why I'm not selling. So why would I sell? Well, in the end, provided it's not confiscated or not taxed at some exorbitant amount, it will be revalued, and I will then convert my gold back into whatever the new unit of exchange is. Let me gold back, one way or the other, or I'll take my gold and I will exchange it for other hard assets, land, art, things like that. Hell, I can't even remember what the original question was now.
That's all right, because there's several questions here. I'm just going to gloss through them because they do pertain to, at what point in this whole process would you actually start exchanging your gold for other hard assets?
I wouldn't even begin to think about it until the current system breaks. Not necessarily the dollar system, but this fractional reserve bullion banking system. Until that physical paper connection breaks and we actually get to figure out how much gold there is, and we get an actual something close to what that fair price is, whatever that is, I wouldn't even begin to think about selling it. So, and again, that may come next year, that may come 3 years from now, but that day's definitely coming, no doubt about it. But I wouldn't even think about selling it until that happens.
Yeah, no, agreed. You'll know when the time comes.
Oh yeah, that's right. We had a interesting episode this evening. It's happened a couple times in the past. Everything's run by computer these days, as I've been lamenting earlier. And sometimes these algo trading programs get left on while all of the paper electronic markets are closed. I've seen this happen before on holidays. I don't ever recall it really happening just during V-Day. Metals futures trade for 23 hours and 15 minutes every day. They're closed between 5:15 and 6 New York time each day. Well, today, during that time frame, one of these algos kept running on the spot market, and some of the charts began to show a gold price at $1,300 and $1,400 an ounce. And people were all like, "Oh, here it is! This is the beginning of the end! I knew this was going to happen." We've seen it before, and and
the janitor hit the switch.
Yeah, and again, it happened, and trading resumed at 6 o'clock, and we were at $1,200. However, those that saw it happen, and if you're listening to me right now, I'm talking to you, I bet you were sitting there going, "Oh, crap! I knew this was going to happen. Why didn't I buy more?" right? So you saw, even though it was a phony baloney, it was nothing. You saw what's eventually going to happen someday. And your reaction was probably like, damn, I wish I had more.
I'm going to ask you a question about psychology that I'm just going to snap on there. When the metals prices are down this low, the physical metals prices, why is it that the staunchest gold and silver bulls don't buy? Why do people not buy? Why are people going to start buying silver when it's north of $20 again and say it's time to get back in it now?
And that is investor psychology. And I remember I spent in the 90s, from 90 to 97, I was a stockbroker of all things. And that's an absolute market truism. You know, when stocks are on sale, nobody wants them, right? Hey, guess what? It's 20% cheaper than it was yesterday. Oh, I don't want any of that, man. It's going down. That's the Western investment psychology. It's 180 degrees out of phase with the Eastern, you know, who just see value and they realize with the paper price going down, we want more of it, right? As the price collapsed in 2013 and the big manipulation then, look at what happened to Chinese demand that month, okay? But here in the West, unless it's going up, man, I don't, you know, I want to put my money someplace else. I get that all the time. God, Turd, you're so stupid. Don't you wish, you know, in 2011, you'd have sold all your gold at 900 and bought the S&P. Well, I suppose if I'd known in 2011 that the system, which could end overnight, would actually have made it this long, with that hindsight, you know, that probably would have worked out okay. But I don't lose any sleep over the fact that I didn't do that, because I know that the whole system is a house of cards, to use that metaphor, and it could have collapsed at any time between then and now.
Mm-hmm.
And so I don't lose the slightest bit of sleep over that. But it gets back to the Western psychology. And frankly, that explains in large part price action in the metals this year. Readers of my site will know that I have been, every couple times a week, I'll put up a chart showing the price action since that collapse of 2011. And there is a very clear downtrend line. That every time price has begun to approach that line or get above it, the bullion banks have acted and have mercilessly driven price back down below it. And I have contended ever since we first figured this out about a year ago that the banks were doing that because you have to keep price trending down to keep sentiment down. Because if sentiment returns as price rises, Western demand is going to return, Western physical demand. And as I've been stating several times during the course of the show, we're already at a physical breaking point just because of Eastern demand. All of a sudden, Western demand comes again, and everybody wants to own gold in Switzerland, and own gold here and there, and you know, and in their vaults, and in, you know, and all these different companies. That will break the system, and so they're doing everything they can to continue to drive price down and keep sentiment down with it. Because that's just the way we in the West are wired.
With our timing here, go ahead, Kerry.
Well, they can't. That line can't be driven to zero, right? I mean, eventually that trend's going to break, and that's the corner that they're painting themselves into. That trend line, if you think of a downward sloping line, is going to intersect with that 1180 support, or if you want to call 1130 the final support, either beginning of next year or sometime in the first quarter. And then I think that's about the time that the fireworks really begin. So I really think, and again, I mean, you're talking to a guy that in fall of 2012 thought, you know, like I said, it's damn the torpedoes, and I couldn't have been more wrong in misunderestimating the power of the banks. But as we sit here now in 2014, knowing all that we know, knowing about the physical supply stress, and where we are right now today, I'm very confident that next year is going to be an exciting year. Very exciting year. You know, we'll just put it that way.
Yeah, I just add, going back to the last question, wouldn't it be nice going into the S&P? Well, hey, wouldn't it be nice? I knew my house wasn't going to burn down or get robbed for the past 10 years. I could have just canceled my homeowner's insurance, and it would have, I'd be tens of thousands of dollars ahead right now.
I didn't die. Dead in time.
Life insurance, too.
Life insurance, exactly.
Oh, yeah, could have gotten rid of that. Would have been great.
Rocks. Yeah, exactly. And so, to your point, it would be nice. Wouldn't that have been great? Sold everything in 1920, the day that the Swiss pegged the franc to the euro. That was the peak, not coincidentally. And then just last week, or 3 weeks ago, I sold everything, all my stocks, and bought gold back. Got himself down my ear. But it's not that simple. I don't lose a moment's worth of sleep over it.
Yep. You mentioned Eastern demand and lack of sentiment in the West. I'll just use this as our final question because we're just coming up on that 90-minute mark. What's the big stick that China has been using to force tons of gold from the Western world to China?
You mean like a lever? How are they making it happen?
Yeah, that's the question.
They're just buying it. I don't think there's any magic to it at all. I mean, they're just buying it. I think they're buying. They've been. First of all, there's some question as to their involvement in the futures markets. Because the Chinese have been notorious for decades in the agricultural commodities. If they know they're going to be buying millions of bushels of wheat because their crops failed, they'll go in there, and they were notorious for selling the crud out of wheat futures in Chicago to jam price down before they made delivery. So there's a school of thought, and there's probably some validity to this, that they're actively involved in suppressing the paper futures market too. So that in the dollars that they're committing and transferring into hard assets, they can get more and more of it. But they've got to be careful. I mean, they can't just import 200 metric tons a month or a week. I mean, they do about 50 metric tons a week. They can't do 200 metric tons a week because that will break the system, and then they won't be able to get any more. So they are systematically draining the West of its gold. And no doubt. I mean, all of the signs are there. We're being told that. There's a gentleman with Bloomberg that went on Bloomberg television. This very well-connected guy by the name of Ken Hoffman told us this time last year that the vaults of London, which used to hold 26 million ounces, are now empty. They used to be stacked from the floor to the ceiling with gold bars. They're all gone. We get the reports out of Switzerland. Like I said, they're running 24/7, re-refining those bars and recasting them into the kilo bars. We get reports from those same miners saying that the bars they're receiving now are all dated with serial numbers from the 1960s. The Germans got some gold last year, but a lot of it had to be re-refined, which led a lot of us to think they were getting coin melt bars from the 1930s. Which is what that is when the U.S. confiscated gold from its citizens in the 30s. They melted it all down. They took everybody's coins and melted it, coin melt, and poured it in bars. It's 90% pure. That's what sits in Fort Knox. And so we were shipping them not their original gold back. We were trying to ship them our crappy 90% gold back. And they had to re-refine it to make sure it was pure before they took it back into delivery. I mean, all of these signs are there of all this incredible physical stress that the Western gold just it isn't there anymore, or what is left doesn't have clear title. And again, that's the Chinese they're not want to break that until they're ready. And so they just continue to buy it. They just continue to convert their dollar reserves into other things, one of those things being gold. And they're doing it at a steady, gradual pace. They imported something like 2,000 metric tons last year. They're on a pace to do almost the exact same amount this year. And they will continue to do so until they can't anymore, I suppose.
Excellent. Well, this has been superb. Craig, thank you so much. This is, God, 90 minutes has just flown by, Kerry.
Yeah.
As usual.
Time flies. Time flies.
Well, we made as we talked before, the webinar here, Kerry, the next question that I'm going to be unable to get to in the list is actually going to be the winner of the videos from the Liberty Mastermind. So the next question I'm going to click on here is someone named Matthew Noble. So Matthew, I'll be tracking you down by email tomorrow and sending you the videos from the Liberty Mastermind from February. And you can hear Craig's speech and his references to Ferdinand Lips and Gold Wars and everything else that was from that symposium. Kerry, yes, there you go. There's the book. Exactly. Kerry, we're going to probably do another one here. We haven't picked a date, but we're looking at next year. Obviously, we're at the end of this year right now, so nothing's going to be happening in 2014. We'll be having a pre-election symposium, probably 2 of them, and so we'll keep everybody posted on that. And so it'll be good if there's some activity and some synergies in the metals prices. It is always, people have asked us, we're very thankful to our very loyal participants and attendees who have come, many of them, to both of the symposiums that we've had. It's a lot of time. You've gotten to know literally all the speakers that are there. It's developed into quite a little network, and we thank you for that. So we urge you to come to the next one, but it is, some have asked why we didn't do one this fall. With metals prices just being this low, even the most, dyed-in-the-wool gold and silver bugs, it's still a challenge for them to come out when the metals prices are this low. So if things start to inch up even a little bit after the first of the year, we're going to be looking to put something on our calendar. So I just want everyone to know that that's going to kind of be our hairpin trigger here to get something out for everybody. So we'll keep you posted on that in real time. Kerry, any final thoughts?
Just thanks for joining us, and we really do enjoy connecting with you all. And hey, just stay tuned for the next one. Probably won't get to it till after the first of the year, but if we can put one together before, we'll notify everybody. And thanks. Everybody have a happy Thanksgiving, and stay tuned.
Excellent.
Thanks, guys.
Thank you, Craig.
All right.
Yep.
Hey, thanks, Craig.
Thanks, everybody, for joining us.